Our next guest says we are going higher from here, but it won't be the bull market you knew before. Let's bring in Jonathan Golub, Chief U.S. Equity Strategist for Credit Suisse, who was at the Economic Club event where Jerome Powell spoke earlier today. Jonathan, good to have you.
Good to be here.
Do you agree with our assessment in terms of whether Jay Powell said something different?
He absolutely said something.
Okay.
I mean,
Right.
I'm sitting at the Economic Club lunch, and here's what happens. He speaks at a certain time, and about 2 minutes before, the transcript comes out, and everybody gets it on their phone, and they're reading, and they're not listening to his introduction. And the only thing that they care about is he basically said, let's call it what it is. Guys, we're kind of done here. Right, the futures market was saying that we have one in December, one something in the neighborhood of March to June, and then here's the story for next year, soft landing. It's not like they simply were finished with their hiking cycle. They went from zero rate policy. No country has ever gone from zero rate policy back to neutral, and he told you today that we're going to pull this off. And yes, is growth slowing next year? Of course it is. But we all knew that we were way above trend because of all the stimulus. So if I would have polled all of us, do you think we're going to have another 3% GDP year or 23% EPS? Every one of us would have said no.
Although that's what this administration is pressing into the deficit. So, there's a lot. I agree with everything you just said. So I think we're on the same side. But you can't tell me that this market, many people don't think that these tax cuts are the gift that keeps on giving. I think they're
I wasn't for the tax cuts. I think that with an economy in decent shape, you didn't need to pump this thing anymore. And Guy, I agree with the point that you're making. The tech sector is not down because of a comment that was made. Was he the catalyst maybe that it happened that day? Who knows?
The growth value switch that we saw, the rotation growth value, had zero to do with the Fed.
Maybe a small part of it if it was at all. Here's what happened. Positioning across the hedge fund community, they were hugely long. This concentrated tech momentum growth trade. Somebody somewhere got spooked. They put it, all of a sudden
because
the
rates
market
were moving higher.
Well, I don't think so, because I'll tell you right now, if you look at when he spoke in October, look at the Fed funds, futures, 10 basis point move. It wasn't like the market said he's going to move 50, basis points more. I don't think it was. No, I think it was a correction on positioning.
So compared to 12 hours ago, you're more bullish on the markets now, or no?
No, not really. Here's what I think.
Not really.
No,
so he's changed his tone.
Well,
but it hasn't changed your view.
Well, because the market before was saying that we have 2 more rate hikes. That's what it said before. Powell basically said I'm agreeing with the market. The market was saying he was never going to move. And I disagree with Steve Leisman, who basically said a long way is 4 hikes, and the market was saying 2, and he basically said today guys, it's 2, and if that's what it is. So, but we were going to go. My read is we're going to go there anyway. So we would have gotten this bounce today. We would have gotten this bounce in 3 weeks from now. I think we're going to get this one way or another. I think it was oversold.
What do you want to be in then in this market environment?
I think the big change though is that you don't want, and people hate this, you don't want to be in cyclical stocks going into next year, because I think the economy is legitimately going to be weaker. So I just downgraded industrials, I downgraded materials. Banks I had as an overweight, I'm now neutral weight, which means I think growth wins again. Tech is good. We upgraded healthcare, because in an environment where you have slightly weaker growth, again, not recessionary, slightly weaker, you buy stuff like that.
So tech stocks didn't go down because of the Fed in the month of October, and they went down for their own fundamental reasons. I don't think
it was fundamental. I think it was a positioning thing. I think the hedge fund community, technical sell-off, and I think so in the near term, I think that tech is going to bounce very hard.
But Apple, Amazon gave you terrible guidance. Facebook's in a world of pain on regulation. Google's in a world of pain on regulation.
Take a look at the beats this quarter in all 5 of the FANG stocks. All of them killed it. And if you look at the response for next year's earnings expectations for the 5 companies, they were up, they weren't down. So you can say, Apple, had slightly weaker, results on units, but their revenues were higher.
Weaker fourth quarter guidance. Amazon, weaker fourth. We're talking about the guidance.
That's what I heard.
But look at the earnings. Look for the broad market. Look at the overall earnings estimates. In aggregate, they're kind of smack in line with what's normal.
Jonathan, good to see you. Thank you. Jonathan
Good to be
Golub.
here.
Najarian, what do you do here?
Well, to his point, talking about tech, I actually bought a little bit more Intel today. I actually took off a Microsoft position today, so I was moving around a little bit. I'm still long the stock. I took off the options because that was one of those very short terms. Those expire Friday, Mel. They were just buying them yesterday. that moved that much just in a single day to start saying, I'm going to take these off. But I bought a little CVS as well. There are certain names out there that I think have interesting storylines, and so when the options are there, I'm jumping in.
Yeah, we flagged healthcare, specifically hospitals, on Monday. I mean, look at the move in THC over the last now 3 trading days. But big cap pharma continues to trade well. I mean, Pfizer's up against $45, a level it hasn't seen in quite some time.